Today we're diving into the most mysterious and versatile metal in human history, gold. From ancient Egyptian tombs to modern finance, gold has shaped our world. Over the next 15 minutes, we'll explore its supply and demand, price drivers, recent rally, and the core mindset of both professional and individual investors. Gold's total above-ground stock is about 210,000 metric tons, enough to cover a soccer field only 1.5 meters high. All that gold could fit into a single 22x22 Memit's cube, far less than most imagine. Two-thirds of it was mined after World War II, and today annual output stands around 3,000 tons. Key producers? South Africa historically accounted for 1/3 of cumulative mine production. China, Russia, Australia, Canada, and the US each produce 200-300 tons annually. Despite technological advances, global supply has remained remarkably stable over the past 2 decades. Miners excavate only where it's profitable. Demand splits into 4 main categories: jewelry, official reserves, private investment, and industrial use. Jewelry, nearly half of annual demand. China and India alone consume 60% of jewelry gold. Middle Eastern countries lead in per capita consumption. Official reserves. Central banks hold gold in 36 countries via the Fed's vault in New York, 5,800 tons, or 4% of above-ground gold. Since 2022, global central bank purchases exceeded 1,000 tons per year. Private investment, physical gold, bars and coins versus financial products, OTC, futures and ETFs. Physical gold incurs 3 to 10% trading costs but offers peace of mind. Financial products boast high liquidity and dominate daily trading volumes. Industrial and medical, about 15%, electronics, corrosion-resistant components, dental work, and even edible gold leaf. With no cash flows or intrinsic valuation, gold price hinges on supply versus demand, and within demand, investment is king. Investment demand comprises A. Inflation hedge and safe haven. Gold typically moves opposite the dollar and stocks, preserving purchasing power over decades. Yet its hedge works only over very long horizons, 15+ years. Short-term correlation is weak. B. Love and speculation, emotional attachment, pure love, and retail speculation amplify short-term swings. Retail investors chase rallies and panic sell on dips, causing sharp volatility. Average annual moves around 20%, even higher than equities. Normally gold rises when the dollar falls. This time both rose together. So what's driving it? Central banks' steady buying, notably China's, has anchored gold at historic highs. Fears of a US hard landing and renewed inflation worries have released more investment demand. Media hype and social media buzz around gold's rally created a self-reinforcing loop. Broader public interest fuels more buying, which then fuels more buzz. Despite gold's diversification benefits, institutions rarely hold it. Over 80% of asset managers either avoid gold or cap allocation below 5%. Reasons: high volatility demands higher return expectations. Drivers are hard to quantify, making it difficult to justify to clients. Heavy gold losses are hard to explain, whereas equity or bond exposure can be rationalized with data models. Retail investors have advantages. No need for complex models, just follow your gut. Gold offers an emotional and speculative play when other assets seem unattractive. A modest 5% allocation can effectively hedge portfolio risk without overexposure. Key reminders for gold investors. High volatility, expect plus 20% swings annually, prepare mentally. Long horizon, for inflation protection, hold 10+ years. Short-term returns are unpredictable. Cost awareness, physical gold incurs 3 to 10% trading fees plus storage and insurance. Diversify, don't put all your eggs in one basket, cap exposure. Use caution with technical analysis. Gold's drivers are emotional and speculative. Traditional chart patterns may mislead. Summary and takeaways. Long-term, gold can preserve wealth and diversify, but requires patience. Medium, short-term, driven by emotion and speculation, offering trading opportunities but with high noise. Institutions, small allocations, around 5%, are optimal hedges. Individuals, Balance emotional appeal with prudent sizing to avoid overcommitment. For deeper data on global gold supply, demand, and price trends, visit the World Gold Council's website. Its free data downloads are perfect for further analysis. Thanks for watching. If you have more questions about gold investing, drop them in the comments. Like, subscribe, and hit the bell icon for future videos. See you next time.